Good evening, class, and welcome to our advanced taxation class for today. My name is Chima, and today the topic we will be discussing is capital allowances. Now, capital allowances is part of the taxation of business income. So, capital allowances is always featured whenever business income is being spoken of. So we have a lot of tax liabilities to calculate for businesses, be it normal operation, pioneer legislation, which we've done. We have merger and acquisition, which we'll do later. And going to the oil sector, petroleum profit tax or hydrocarbon tax, even the mining taxes, and even small specialized businesses, you will need to know how to compute capital allowances. So that is a requirement for you. All right, so capital allowances is contained in this second schedule to the Company Income Tax Act. There is a provision in that second schedule called capital allowances, and it is granted in lieu of depreciation. So when we say in lieu of something, it means instead of that. So depreciation is a disallowable um, item for tax purposes. And so instead of using disallowable this depreciation, we use capital allowance. Depreciation is the depreciable part of an asset written off over the useful life of the asset. So it means that if you have a motor vehicle and you bought it for 1 million naira, and you say you are going to depreciate it, the useful life is 4 years, and when you depreciate it, there will be no scrap value. It means that for every year, if you're using straight line method, for every year, you are going to be taking 250,000 for 4 years. If it is 5 years, you take 200,000. Now, there are several methods of calculating depreciation. There are several methods of calculating depreciation. We have the straight line method, we have the reducing balancing method. These are two popular methods. And when you calculate depreciation using any of these two, you will get different values. Let's say, for example, two companies bought the same vehicle on the same day, and these two companies are into the same thing. They have the similar basis period, and one of them is using straight line method, the other one is using reducing balancing method. Both of them bought it the same amount and they have the same useful life. You find out that one of them will be paying a higher depreciation every year, and the other one will be paying a smaller depreciation. So depreciation is an estimate. None of the methods of depreciation is enforceable by the taxpayer. I've said it, one of the reasons is because um, different values for the same asset. Consequently, taxpayers are at liberty to choose any of the methods. So there will be no uniformity. There will be no uniformity when they choose straight line method, the other one choose reducing balancing method. And you find out that sometimes too, because it's an estimate, they might change and say, okay, for the past 2 years, we have been using straight line method. It's not the best method. Let's change to reducing balancing method. And all these frequent changes to this estimate will distort what is given as capital allowance. So it could be used in a fraudulent way. Also, different companies could decide to use different lifespan. For example, you bought the vehicle on the same day, two companies bought the same vehicle same day, even though both of them are doing straight line method or the same amount, the same method. If one of them says that the useful life of his vehicle is 4 years, and the other says it's 5 years, and assuming it's 1 million, the one of 4 years will be paying 250,000 naira, will be providing 250,000 naira for depreciation every year, while the one paying using 5 years will be providing for 200,000. So you see, even in the same method, different lifespan could cause a difference. And so capital allowances are um, is introduced so that it reduces all taxpayers to a common base as the rate. So it means that capital allowances does not give room for speculating the useful life of your assets and the method to use in order to get this allowance. So that's why we say capital allowances are given in lieu of depreciation. So while depreciation may be allowed or allowable in financial statements, okay, the IFRSs allow you to change your method of estimate, to choose different method you want to use for your depreciation value. The tax, the tax law will not allow depreciation, but will give you a unified rate in the form of capital allowance. Now, capital allowances are relief granted to any company which incurred qualifying capital expenditure during a basis period in respect of property, plant, and equipment in use at the end of the basis period for the purpose of a trade. Now, there are several things we may need to highlight here. Capital allowances is granted to company, now not just to individuals. Although in sole proprietorship, individuals may be said that it may be said that the sole proprietorship business is under the individual, but because it is a company, no, it is because it's a business entity using it for the purpose of trade or business, capital allowances can be claimed. Now, it means both companies, sole proprietorship and partnership can use capital allowance, and it is for the purpose of business. So it means that if you are using it for private use, you cannot claim capital allowance. So it means that if you have vehicle that is private use, you cannot claim capital allowance. But if it is official use, you can claim capital allowance. Little wonder many people want to make their vehicle to be official vehicle, even if sometimes they usually use it for some personal purposes. Now, when we say property, plant, and equipment, we are talking about land. Land is a property, plant and machinery, office equipment, motor vehicle, all these are machinery, all these are equipment. Furnitures and fittings are all equipment. So this name plant, property, plant, and equipment, PPE, encompasses everything. Now, one thing about capital allowance is that at the end of a basis period, the asset is still in the coffers of the company. The company is still the owner of the assets. Is still the owner of the assets. So it means that if an asset has been disposed of before the end of the basis period, you can only claim capital allowance for the period of which the asset was in a property of the company. So if an asset has not been bought in the beginning of the basis period and was bought sometime in the basis period, from when it was bought to the end of the period, the capital allowances will be claimed. Now there are allowances that we will claim that are divided into different types. We have initial allowance, we have annual allowance, we have balancing allowance, and investment allowance. Now we are going to talk about all these allowances now. Initial allowance. Now, when we say initial allowance, what is initial? Initial means the beginning, the first. So this is the capital allowance that is granted in the first year. Underline the word here, first year of the acquisition. First year of the acquisition on the cost of purchase of the assets, whether purchased new or second hand. But there is a clause when it comes to building. So you bought an asset, the asset is being put into first use in the company. So because that is the first time you're using the asset for your company, you will claim initial allowance. Initial allowance, one of the characteristics is that it is granted in full. It is granted in full, irrespective of the number of months in the basis period for the relevant tax year. So it means that, let's say an example here, an initial allowance of 25,000 will be claimed for a qualifying capital allowance amounting to 50,000. Okay, so that means that if you bought an asset 50, let's say it's 50 million, right? This asset is 50 million. Let's say it's a plant and machinery. You bought it for 50 million and you put it to use in 2021 year of assessment. That's the first year it is being put into use. Let's say you are running a January to December calendar or basis period or company period. Let's use that for the sake of simplicity. And you bought that asset and you put it to first use in December 31st. You will say, this is December 31st. The month is ending that day. But you will claim full capital allowance for that year. And let's say it is 50%. Let's say it's 50% the initial allowance. You will claim initial allowance of 25 million for that year because of putting it to use, even if it is on the last day that you put the asset into use. That's what we are saying. Let me give you another example. Let me use something from ICANN. Let's say this is just a way of understanding it. Let's say you are applying to become an ICANN registered student and you pay for your registration, and ICANN gives you its membership. You know, The moment ICANN gives you its membership, you are owing them. It means that you now have liability to ICANN to pay for membership fees or your subscription, as they call it. So your subscription is due when you get your registration number. So that's it. Even if you get your registration number on the last day of the year, ICANN will still ask you to pay. So it doesn't matter now whether you put the asset in first use in January 1 or in December 31st. As long as that asset has been put into use, you have a duty to remove capital allowance. The initial allowance to be granted will be such an amount as the FIRS or the Revenue Service may determine to be just and reasonable, where either the seller has control over the purchaser or the purchaser has control over the seller of the asset. Okay, so let's look at that. Let's go to the initial annual allowance. Annual allowance is an allowance you deduct or relief you are granted every year as long as the asset is in use by the company. Now, this asset is usually computed on the remaining balance of costs after the initial allowance has been claimed. Now, this is what we mean here. We are saying that annual allowance here, I'll call it AA, is claimed after you have deducted initial allowance from the costs. So annual allowance is now claimed over the useful life of assets. So initial allowance doesn't look at the useful life, but annual allowance is the remainder after initial allowance has been claimed and is spreads over the useful life. Now, unlike an initial allowance that is given in full, annual allowance is calculated on pro rata basis. So if any basis period is less than 1 year, the annual allowance will be proportionally reduced. So you cannot claim annual allowance for an asset that you use for 6 months, the same amount that someone who will use it for 1 year. You cannot claim the same amount for annual allowance that will be used for 1 month, the same way you use for 12 months. So to make this formula look better, we will come here now and say multiplied by n over 12, where your n will be the number of months that is used in the basis period. We can call it either n, which is number, or we can say m. M will be months, number of months used in the basis period. We'll get to that. Then we have investment allowance. Now, in addition to initial allowance, investment allowance is claimed only on plant and machinery on the first year that plant and machinery is being used. Now, like initial allowance, it is not prorated. It is claimed once in the lifetime of the asset, but the rate is 10%. Now, one thing that is also glaring from initial allowance and investment allowance is that the investment allowance is not to be deducted from the cost of the assets. So it means that this is an extra allowance given to you and is not deducted from the cost of the asset. So it means that when your initial allowance is calculated, it is being deducted from the cost of the assets before you get your annual allowance, right? And your annual allowance is also deducted for the first year. When you go to the second year, you deduct again until the useful life is done. But for initial allowance, it is calculated 10% on cost and it's not used to deduct from the asset. So even though initial allowance happens to be the first allowance calculated, whenever an asset has an investment allowance, we usually calculate that first and we'll now go to initial allowance, then we'll go to annual allowance. All right, so let's go now to something called rural investment allowance. Now, we said investment allowance is when you invest into a capital asset, but a special capital asset called plant and machinery. For rural investment allowance, you are investing in a rural area. You are investing in a rural area where there are no facilities that government should ordinarily provide so that business environment can thrive. So you are providing such to support the government. So instead of the government, and so you are helping the government that instead of the government to do all of this, you are taking the burden upon yourself, and the government will compensate by allowing you to deduct it as an allowance. So when there are no facility at all, that means there is no electricity, there is no water, there is no tarred road, you take 100% of the expenditure incurred as rural investment allowance. So that means you provide electricity there, you provide water, you provide tarred road. Now these are not inside this property, plants and machinery, because electricity is not property, water and tarred road are not property. So these are just infrastructural. So when you provide those things where there was none, you take 100%. Now, if you were going to a place where they have water, they have tarred road, and no electricity, and you now provide electricity, you are to take just 50%. Now, when there is no water, just no water, but there's electricity and there's tarred road, take only 30%. But when there is electricity, there's water, and there is no tarred road, you just take 15% of the expenditure. So if you can see now, if you add electricity, water, and tarred road, it doesn't give you 100%. It only gives you 95%. Hmm. So it means that for someone who just go to a place where there is no tarred road, all the expenditure you make, you are just getting 15% of it as allowance. rural investment. So someone would like to want to go to a place where there are no facility at all and want to invest because he's getting all of them. There are characteristics of investment allowance. One, it is claimable only on specified capital expenditure, and this is going to be plant, equipment, and machine. So these three keywords, anytime you see a question telling you plant, just plant alone, or equipment alone, or machinery alone, you use them. Sometimes you see plant and equipment or plant and machinery. Now take note, equipment is different from office equipment. Equipment here has to do with like tractors and other things that are earth moving equipment. Office equipment could be like furniture. These are two different things. Investment allowance is claimable in the first year in which the asset is put into use by the taxpayer. Then it is not taken into consideration when the tax written down value of the asset is being computed. So it is not deducted with, sorry, this is rural investment. It is not deducted along with initial, okay, this is just normally investment allowance, whether rural or normal one. It is not deducted deductible along with the initial and annual allowances from the cost of the qualifying capital expenditure. I explained that before. In any year of assessment where rural investment allowance claimable is not fully utilized, it cannot be carried forward as in the case with initial and annual allowance. So if it is not fully utilized, you don't carry it forward. So what it means is that if you do not make enough profit, accessible profit or so, to claim this allowance, this rural allowance, you cannot carry it. You cannot carry it. Hmm, that's so serious. So it means that if you have to do this, you need to do it where you know you make profit. Then now we'll come to balancing allowance. What is balancing allowance? When sales value of an asset is less than the tax written down value, the related laws shall attract balancing allowance. Now let me explain this. You have an asset, and I said an asset will only qualify for capital allowance if it is also the property of the company as at the end of the basis period. So you now have, let's say you bought an asset for 10 million or so, and you've taken initial allowance. Let's say initial allowance is 50%. You've taken 50%, which is 5 million gone, and the asset is being used for 5 years, right? That means the remaining 5 million, you're taking 1 million every year. Now you've taken the first 1 million, it remains 4 million. You've taken the next 1 million, remains 3 million. You take another one, it now remains 2 million. Now this, let's say your tax written down value, which is this balances, the tax written down value happens to be 2 million, but you decide to sell it. Let's say the asset is obsolete or so, and you need to change the asset because of new technology or so, impairment, and the sales value, or call it the sales value of the assets, you now sold it for 1.5 M, 1.5 million. Now you can see here that sales value is less than tax written down value. Now, the implication is this: if you have not sold this asset for 1.5 million, you would have claimed 1 million in this year and the remaining 1 million in the following year. You would have fully claimed your 2 million. But because you sold the asset and you want to quickly claim all that is remaining, instead of claiming 2 million, you are able to claim 1.5 million. So the difference of 500,000, which is 0.5 million, is a balancing allowance. So that difference you couldn't collect because you sold your asset less than the balance, the tax written down value, is a balancing allowance. So it is claimable as additional allowance along with other capital allowance items discussed above. Now, the opposite is balancing charge. So let's flip the coin now. Your sales value, which I call SV, you now sold it at 2.2 million. Meanwhile, your tax written down value is 2 million. There is a difference of 0.2 million, a positive difference. Now, because you are supposed to claim 2 million, you have now gotten 2.2 million. You have gotten profit or excess over your tax written down value. Now, capital allowance is not something that you are supposed to make gain from. Government is saying, because you've invested in capital expenditure, we are allowing you to recoup it, claim it, because this is not your day-to-day running of your business. You spend money, recoup it, and use the money to run your business, but don't make profit out of it. So you now make a profit of 200,000. Oh, government say you make a profit, you are going to pay a tax charge on that 200,000. So that charge given on this is called balancing charge. Government wants you not to make profit. If you make a loss, government will reimburse the balance. If you make a profit, government will tax from the profit. All right. So we now go to capital allowance rates. As you can see here, these are the capital allowance rates. So this is the initial allowance, this is the annual allowance, and this is also what is here so that you can see it well. This is also will be given to you in the exam. This will be given to you in the exam. It should be noted that in respect of qualifying expenditure on plant and machinery for the replacement of old ones, a one-off 95% capital allowance in the first year shall be allowed. 5% book value shall be retained until the final disposal of the assets, provided that the aggregate capital allowance granted in respect of any assets shall not exceed 95% of the total cost of the asset. That's not a much thing to bother about. A company engaged in gas utilization, that is downstream operations, shall be granted accelerated capital allowance after a tax-free period of 3 years as follows. Annual allowance of 90% with 10% retention or for investment in plants and machinery. An additional investment allowance of 15%, which shall not reduce the value of the asset. So that's not much of importance to that. Where double taxation relief is applicable, Section 2, paragraph 23 permits a company to elect that the initial or annual allowance due it be calculated at a lesser rate than which is normally applicable as summarized under capital allowances as shown above. Most times these are not being tested. This number 1, B1, B2, and B1 and B2 are not tested most times. C is not normally being tested, but pay attention to D. Capital allowances to be deducted from where accessible profits of a company in any year are restricted to 66.2/3. Now look at the way they wrote it. This is the right way it should be. This is the right way it should be. It should be 66.2/3% and not 662/3%. There are two different things. There are two different things. Let's demonstrate it. If we are to use this, what this is telling us is 662/3. When we say percent, it means times 1/100. Now what this thing is telling us is 662/300, which is wrong. But looking at this is what it is telling us. 66.2/3%. You change it from improper fraction to a whole number, to a proper, sorry, change it from whole fraction, mixed fraction rather, to a proper fraction. You say 66 times 3. 66 times 3, what does it give us? Let's see. 66. What's happening? 66 times 3. That will give you 198. Now add 2 to it. 198 plus 2. That will give me 200. So this is going to give me 200 all over 3. Now percentage means times 1/100. Now this one will be 200 times 1 will give me 200. 3 times 100 will give me 300. So when you cancel, 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 and cancel, it becomes 2/3. So this is what they mean when they say 2/3 of accessible profits. The law says it is 66.2/3%. It is 66.2/3%. When we change it from percentage to fraction, it becomes 2/3. Remember, it is 66.2/3%. When you are using 66.2/3, put the percent. When you are just using 2/3, don't put the percent, because it is this 66.2/3% when simplified that gave us 2/3 without the percent. Take note of that. So don't go and make the mistake of saying 2/3%. 2 over 3% is as saying 2 over 300. And if you see this other one, don't go and say 662 over 3%. No, that is going to give you 662 over 300, which is like good as saying, if we are to divide this now, we are to divide this, and we say 662 divided by 300. Calculator is not coming up. Let's see to recognize what I just divided. 6, oh, it says 62. Sorry, I'll do it again. 662 divided by 662 divided by 300. That will give you, this one will just give you 2.207, 2.2067, which is not what we are looking for. So this is what we are looking for. So don't be confused if it is like this is a typo. It should be this way. I wrote it before. It should be 66 2 over 3%. Now, we are saying that capital allowances to be deducted from assessable profits shall be restricted to 66 2 over 3%, which I will say 2 over 3 of assessable profits, except for companies engaged in agro allied industry and manufacturing. So it means that if you are reading a question and you see that the company is into manufacturing or is into agriculture, then you know that their capital allowance will not be restricted. Another restriction for capital allowances will be when there is a private use. So it means that let's say vehicle, you have vehicle, and you're using it for office and for private use. And let's say, I'm just using an example, out of 7 days in a week, the vehicle is in use 7 days a week, right? Then it means that if official use is only on Monday to Friday, Saturday and Sunday is for personal use, even after you have calculated the total capital allowances, you still need to restrict it to 5 over 7 of that, because you use it 5 times out of 7. So it is restricted to official use. Then there's another restriction again, a basis period that is less than 12 months. It is restricted to the number of months in the basis period that the asset is being put into use. So that's it. We are using it for 10 months. Most times it's usually in the first period. If you didn't buy the asset at the beginning of the capital of the basis period, you bought it within the month, you calculate how many months the asset was put into use before you will claim it. So it's restricted. So look at this restriction, take note of that. Then we go into qualifying capital expenditure. I won't talk much on that because all these rates you see here are all qualifying capital expenditures. And that is what they are talking about when they all are discussing here. So you read that, you read all of this. Now let's look at building purchased. Let me just talk about building purchased. So when building is purchased, the relevant interest to the company making the purchase is the original cost of the construction of the building or the price paid for it, whichever is lower. So the cost of the building or the price paid for the building, whichever is lower. If the building is purchased second hand, if the building is purchased second hand, no initial allowance can be claimed by the purchaser, but annual allowance can be claimed based on the amount of the relevant interest as defined above. When a building is purchased new, initial allowance and annual allowances are claimable by reference to the relevant interests. So we find out that when buildings are purchased second-hand, do not claim initial allowance. So sometimes they will give you a question and they tell you building purchased second-hand, no initial allowance. All right. That's only one we want to talk about. The rest you can read on that. Now, conditions for granting capital allowances. Now, capital allowances are granted when the business fulfills the following conditions. One, the company claiming the capital allowance must be the owner of the assets at the end of its basis period for the year of assessment. Now, what it means here is that if you are using an asset that is you are not the owner, that means you cannot claim capital allowance on it. So we are talking about here, you hire motor vehicle from a hiring company and you're using it for business purposes. You can only expend the higher charge, but you cannot claim capital allowances on that. Let's say you are into bakery and you have an oven that is fitted into your company and you are hiring it. It's on hire purchase. So there are two kinds of lease. There is operating lease and there is a financial lease. Now, on operating lease, the asset is not going to be yours, and so you cannot claim capital allowance. But in financial lease, the asset is supposed to be yours at the end of the period, but as at when the lease is ongoing, the asset is not yours. So that is it here. So the asset is not yours. So normally by default, you shouldn't claim assets that capital allowance on them. That is what this place is saying. But there is another principle that tend to override this in terms of financial lease, and it says that the principle of substance over uh, substance. What's the name again? Substance over form. Substance over form. What it means here is that the form is the legal form. Substance is preferred over the legal form. In substance, in financial lease, you are going to be the owner of the asset eventually. So that's the substance. You gain the benefits, you suffer the losses of that asset. So substance is overriding the legal form. The legal form is you are not the owner yet, it's not in your name. That is the only time that you can claim capital allowance when you're doing financial lease. But apart from that, you must be the owner of the asset. The second one here is that the asset must be used for the purpose of trade or business carried on by the company. It said, note that the ownership and usage should be on the last day of the basis period of an assessment. For this purpose, a period of temporary disuse is ignored. So what it means is that we are carrying on trading of the with the assets up to the last day of the basis period of the year of assessment. So we are using January to December now as an example. You are using this motor vehicle or this plant and machinery up to December 31st. It is your owner. You are the owner of it as at December 31st. You are using it as at December 31st. You claim capital allowance. But let's say maybe in June or in July, there was a temporary stoppage of usage. Then maybe you start using it again in September. All those temporary period is ignored. What matters is that as at the end of the year, is that asset in use by your company? If that is so, you will claim it. For it to be in use, that means it must be in your possession. Now, when asset has been acquired but has not been put into use at the end of the basis period, capital allowances can be claimed provided the first use to which the asset will be put after the date is the purpose of the trade or business of the company. If eventually the asset is not put into use, the revenue service can raise such additional assessments as might be necessary to counteract the benefit obtained from granting the capital allowance. So it means that even though you buy an asset and you have not put it for first use, just because you buy an asset and you bought an asset, yes, you are going to use it now, you claim capital allowance. So you need to claim capital allowance for the first year, though you have not put it into use. Now let's say the second year, you now sold the asset or you give it out on higher financial lease or so, or operating lease or anyhow. You are not the one using the asset. It is not put into use by your company. It is another company that is using it now. You are not the one using it. You have already claimed capital allowance. That benefit that you claimed, the revenue service will reverse that benefit. So that capital allowance that you enjoyed will be, you will unenjoy it. Let me say that they will raise an additional assessment that would have been given if that capital allowances was not reducing your assets. So it means that, let's say you have a capital allowance of 1 million and um, your your accessible profit was like 1.5 million before, and when you now add that 1 million, you use that 1 million to reduce it to 500,000, and you now pay tax on 500,000. That 1 million that you enjoy but you didn't put the asset into use, they will reverse it. You will now pay tax on that 1 million. That's the additional assessment that they will raise for not enjoying that capital allowance. Now says the grant for a year of assessment is usually against the assessable profit of the basis period for that year of assessment. So what it means that the capital allowances for a particular year of assessment is used to relieve the assessable profit for that same year of assessment. In the event of insufficiency of accessible profit to cover the capital allowance that is claimable, the unrelieved capital allowance amount will be carried forward to a future years of assessment. So what it means is that you have 1 million accessible profit, that's fine. But your capital allowances now happens to be 1.5 million. How can this happen? It can happen for agricultural companies and manufacturing companies. Why? Because you don't restrict their capital allowance. So what happened? You cannot grant the whole 1.5 that year. You only grant 1 million that your accessible profit can carry. Then you take the remaining 500,000 to the next year. You keep carrying, if there's no profit, you keep carrying it until such a time to accommodate it. Previously, it used to be, I think, 4 years, but now they made it for you to be carrying it indefinitely until the end of the business in cessation period. Now, another thing here is that a claim should be made by the company before any capital allowances can be granted. However, if no claim is made, some allowances can still be granted where the revenue service of the opinion that it will be reasonable to do so. That's not that much importance. Now, where the basis period for any year of assessment is less than 1 year, for example, during commencement or cessation, the annual allowance for that year shall be proportionately reduced. The relief is granted by deducting from the remainder of the assessable profits in the computation of the company's total profit. Now, when we say remainder of the accessible profit, it means that it's possible that they may have two accessible profits, right? You may have two accessible profits. One of them could be something called adjusted profit. Adjusted profit will be your first accessible profit. Then you may now have something called balancing charge, which will increase it, or balancing allowance, which will reduce it, or sorry, any loss that will reduce it. So you have two things that will change your adjusted profit. One of them could be balancing charge, which is additional charge from asset, and loss. When a loss is made and you are carrying the loss from previous year, that loss and balancing charge will make you have a second accessible profit. Now, that second accessible profit is what they call the remainder of the accessible profit. So, what I mean here is that, let me demonstrate it here. You have your net profit, this accounting profit. You now do your add backs and you have adjusted profit. This is also called accessible profit. Okay, then there are two things that will adjust this again. You have balancing charge, you add it. So you add balancing charge and you will less loss relief. When you do that, you have another accessible profit. So this is the remainder. This is called the remainder. It is this one here that you will less your capital allowance. So that's what we are saying. The remainder is where you grant your capital allowances. Now we are told again here that unutilized capital allowances in the year of permanent cessation. Now look at permanent cessation of trade or business carried out by a company shall be available for relief against the remainder of its accessible profit for the preceding year of assessment, and so on for other preceding years up to the 5th year before permanent cessation. So what I'm saying here is this. Let's assume that 20 is your cessation year and you have been doing business for like 10 years, starting from 2020 2003. So you have been carrying capital allowances forward, and on the 2023 year of assessment, 2024 year of assessments rather, which basis period ends in December 2023, you you had no capital allowances. All your capital allowances are not relieved. That means you have, let's say, 3 million unrelieved capital allowance. Normally, you are supposed to take that unrelieved capital allowance forward. But the law says because you are ending business this year, take them backward for 5 years. So it means this year, which is the year of cessation, take it to the year before cessation, take it furthermore, further back until you get to 5 years back. So you count 5 years before the cessation day, the cessation year, and you grant your capital allowance. Now, where a relief is to be granted to the company after the assessment has become final and conclusive in respect of any assessable year, the revenue service may make such repayment or set off of the tax or any part of such tax paid or charged for that year as may be appropriate in lieu of making the deduction for the amount of relief. So it means that as you're taking it backward for 5 years, and let's say the tax office has finally concluded on those years that you are taking them backward, it means you've paid tax and all that that's been concluded. But because if there's a cessation of business, you're taking them back, the revenue office will now return the taxes you've paid so that you can claim capital allowance. Because normally, capital allowances are supposed to relieve you of taxes. So now, because you are carrying those ones back forward, you cannot. So you are now carrying them backward. And as you are carrying them backward, it's as though you are increasing the capital allowance for those years that you paid tax. So when you increase the capital allowances, your taxes is supposed to reduce. In fact, they're supposed to refund you all the tax you paid for that year. And as you're taking them backward, they are refunding you the taxes, taking them up to 5 years. The residue of expenditure is the total qualifying expenditure incurred less the total of any initial and annual allowances granted to date. Initial allowance should not be deducted from the qualifying capital expenditure to arrive at the residue. Said that before. Then we said in the year of permanent cessation of trade or when an asset is disposed, balancing adjustment will need to be made. Then balancing allowance will be granted when the proceed of disposal or the value of the date of cessation is less than the residue. A balancing charge will be limited to the capital allowances previously given when the value of proceed is greater than the residue. All right. So this is still the same thing we've been talking about. So all these are just some repetition. You need to look at them. They said the capital allowances is restricted to 66 to 12% of accessible profit. Any company in the agro-allied company which is engaged in the manufacturing company is now affected by this restriction. Now they are telling you that a company in the agro-allied company industry will be carrying on this following trade: establishment or management of plantation for the production of rubber, oil palm, coffee, tea, and similar crops. Then here again, cultivation of production of cereal crops, tubers, fruits of all kinds, cotton, beans, groundnuts, all of these. Animal husbandry. All right, so let's look at capital allowances on assets acquired on hire purchase. I was saying something about this before. A company or an individual taxpayer wanting to preserve liquid fund or that falls short of it may elect to hire or to enter into a hire purchase agreement. So you see here, you don't have the money to have these assets in your possession as your own, but you may go into a hire purchase agreement whereby the payment is done in a flexible payment period. The asset will still be your own at the end of the day. Since such agreement usually flexes the payment, which is done in installments, the payment is made in piecemeal. Such arrangement will attract some interest on costs. Thus, usually the cost of acquiring the assets will be higher than the cost of the outright purchase by the profit margin. Now look at the hints here. The interest element must be identified and removed from the hire purchase to arrive at the actual cost. We'll see a question on that. We'll identify the date of agreement and pay special attention to dates of payment of deposit and installments. We're going to calculate the amount paid as deposit and installment on due dates. Where there is a default in payment of an installment, identify the actual date of payment. Determine the relevancy of assessment and relevant basis period for each payment. Identify and add all payments, deposit and installment falling within the basis period of each relevant year. Introduce each additional payment in E above as if treating a unit of asset newly acquired and calculate initial and annual allowance on each. We'll see a question on that. In calculating the annual allowance on new additional payment, the number of years already spent by the asset must be deducted from statutory years determined for the asset for capital allowance purposes. We are going to see that in a future question. All right, so now let's come to Finance Act 2019. So that's where things get interesting. The provision of the Finance Act 2019 eliminated the problems associated with overlapping on basis period on commencement of business, because abnormal basis period is no more in operation as the preceding year basis rule applies in accordance with Finance Act 2019. So abnormal basis period usually does not occur. However, if the basis period in the year of commencement is less than 12 months, the annual allowance will be prorated in the year of commencement. So that's where we want to say the year of commencement, annual allowance is usually prorated. All right. Capital allowances for existing business operating under going concern assumption. For this class of business, the tax written down value of the existing assets shall be provided with relevant information relating to details of capital allowances granted on them from the first year of using them to the end of the current accounting year. Also, details of additional assets acquired, cost of acquisition, and dates of acquisition are very necessary for the computation of capital allowance. So, look at the procedure here. Procedure for computation is as follows. Determine the first relevant tax year and allocate the tax written down of asset brought forward to it. Second one, allocate the newly acquired assets to the relevant tax year using the date of acquisition. Then allocate disposal to relevant tax years using date of disposal. Then compute capital allowances as appropriate. So what it means here is that if you are in business, an existing business, say let's say you are into your 6th year of business and you are running a January to December basis period. Now let's say in this particular year of assessment, you bought a new asset in March and you sold an old asset in October. So what it means is that for the beginning of this the year of assessment, you bring the tax written down assets of all the assets on the first day of the relevant year. Now, any assets you acquire within the year of assessment, you bring them in using the date of acquisition of such assets. So you will now calculate your initial allowance on them. Then you calculate your annual allowance on them separately because you're going to prorate them since they did stay up to 12 months. But those ones that were existing, there's a possibility you will do them full 12 months. Now, among those ones that were existing, you now sold one in this year of assessment. That particular one you sold, you will do it separately and prorate it from the beginning of the assessment year up to the date it was disposed. You prorate it, right? So that's it. It is possible that the asset you bought in the year, you sold it off again in the year. So all you need to do, you put your acquisition, put your disposal, you calculate the annual allowances that you claim for that period. And if there is any balancing charge, you can also claim that. If there is balancing allowance, you also claim that. Excuse me. Computation of capital allowances where there is a cessation of business, Finance Act, excuse me, 2019. The implementation of the provision of the Finance Act 2019 removed the issue relating to actual year basis in the penultimate tax year. So if you look at our one of our classes, is it the third or fourth class? We talked about business income. We talked about the old year, which is for cessation. We talked about ultimate year and penultimate year. Penultimate year is the year before the cessation of business. Normally, in penultimate year, we usually compare our assessable profit calculated on preceding year basis with the one we calculate on actual year basis. But Finance Act 2019 removed actual year basis from the equation and also eliminated the possibility of gap between basis period when there is a cessation of business, which was usually the case in the old one. This is because all tax are based on preceding year basis as provided in the Finance Act. Meanwhile, where the basis period in the year of cessation is less than 12 months, the annual allowance will be prorated. Just the same way we did in the commencement of business. Now, computation of capital allowance for small business. Now, they say despite the fact that capital allowances are claimable on capital expenditure used to generate taxable income, these allowances are not allowable. That's one word. Are not allowable or carried forward in the case of small companies. Why? All right. A small company is a company that is under 25 million naira revenue threshold. That means revenue less frank investment income or so. Now, because you are under 25 million, you are not paying tax. Your tax rate is zero. So because you are not paying tax, you will not be allowed to claim capital allowance. Because where are you claiming the capital allowance? On what? Your assessable profit or your taxable profit is zero. You are not claiming tax or your tax rate is zero. You are not claiming capital allowance. So you cannot compute capital allowance. So you say because the company is under the threshold, it will not compute capital allowance. And some people will be computing it and be keeping it. That's fine. You cannot carry it forward. You can never carry it forward. So it means that when your company goes from small to medium, maybe it hits the 25 million naira mark, you cannot say, oh, I'm going to carry my unrelieved capital allowance I had when my company was less than 25 million. No, you cannot carry it forward. So that's it. Then we talked about carry back of capital allowances. Carry back of capital allowances on cessation of trade of businesses. All unclaimed capital allowances are carried backward from the year of from the year of cessation. You will take it backward. So I want to say the year of cessation is usually, let me call it the ultimate year, though that name is obsolete now. The year of cessation is better used now. The year before the cessation, it used to be called penultimate year. So let me still borrow that word. From the penultimate year, you will start carrying it backward. So the penultimate year is the first year of carry back. The year before the penultimate year is the second year of carry back. You will be carrying it backward for 5 years. So that's it. Then anyone you cannot carry, when you get to 5 years and it's still unclaimed, that capital allowance has been lost forever. So that's quite a handful we learned in capital allowances. Quite a handful. So now we want to do some questions. Yeah, it says here on September 1, 2014, Idiaraba Limited entered into a hire purchase agreement with Idiarere Limited. 10 generators were acquired on hire purchase by Idiaraba Limited with 2 million naira paid as initial deposit on that date. This was followed by this was followed by 24 monthly installments. Okay, so sorry for the small break in transmission. Now we look at this question here. It might seem to be small, but it's not a small thing. On September 1, 2014, Idea Raba Limited entered into a hire purchase agreement with Idea Rere Limited. 10 generators were acquired on hire purchase by Idea Raba Limited with 2 million naira paid as initial deposit. So this 2 million naira is initial deposit on that date. This was followed by 24 monthly installment. If you were in the exam and they give you 24 in words, it's good for you to change it to, to letters. 24 monthly installments. So you don't miss that of 200,000 naira commencing from November 30, 2014. The cash price of 10 the cash price of the 10 generators was 5,600,000. Somebody is raising up a hand. Please, can you use the chat button? Let's see what you are asking. Please use the chat button to ask your question. Okay. Someone say I can't see the screen. Oh, so sorry. I will share my screen again. Let me stop sharing. Let me stop. Let me share again. Thank you for that feedback. Please keep your feedbacks on the chat so that I can see them as they come. So if you can see my screen now, please use the chat button to let me know you can see. All right. For the sake of person who didn't see my screen before, all right, that's fine. So you can now see my screen. Just a moment. All right. So now we said 10 generators were acquired by hire purchase and 2 million naira was paid as initial deposit. On what date? September 1, 2014. So the hire purchase went into effect September 1 with the initial deposit. This was followed by 24 monthly installments of 200,000 commencing from November 30th. The cash price of the 10 generators was 5,600,000. What it means here is that if you had paid cash outrightly on September 1, 2014, you would have paid 5,600,000. And that is what is going to enter into your books as your cost of the assets. And we are told that Idea Raba Limited usually prepare its account to June 30 every year. Now we are told to compute capital allowance for the relevant year of assessment. We are told to ignore investment allowance. So what happened? Let's see how we can do this now. So I would say this worked example. I can pack worked example 1. Okay, so let's look at the company Idiaraba Limited. This is Idiaraba Limited. Idiaraba Limited. All right, so what are we giving? These are the things we are giving. Let's bring them out here. Hire purchase was from September 1, 2014. Hire purchase date September 1, 2014. On that date, we have initial deposits. Initial deposits, we said it was 2 million. Then number of monthly installments. Number of monthly installments. So we are told is what? 24. So it means this is 24. 24 monthly installments. Installment is okay. I will say monthly installment start date. So I will say monthly installment start date. We said it was November 30, 2014. November 30, 2014. So that was the first of the 24. So what it means is that 24 monthly installments will be 2 years. So if the first month is November, the second month will be December, the third month will be January, February. So what I'm getting at is that the 12th month, the 12th monthly installment will be October. So it will be October. So the 12th month will be October 31st. We put this in 2014. It's 2014. So the 12th month will be October 31st, 2015, right? That means the 24th month will be October 31st, 2016. So that is when the monthly installment will end. You can feel free to count your fingers, but I usually say if it is 24, that is complete 2 months. If if November is the start month, that means the month before it will be the end month. Okay, so October will be the end month. And now we are told that amount paid each installment. Amount paid in each installment is 200,000. So I'll come here. Amount per installment. Amount per installment is 200,000, and we are told that the cash price, oh, am I writing it twice? The cash price is 5 million something. Let's confirm. 5,600,000. 5,600,000. What again are we giving? We are giving that the company usually prepare this account June 30 every year. So account year end June 30 every year. So these are the things that we are giving up. So it means that we are told to look for the tax, the what do they call that again? Capital allowances for the relevant year. For the relevant year. So it means that the first year, this is in 2014. So the first year should have been running from, since it is June, should have been running from July 1, 2014 down to June 30, 2015. So this is what year of assessment? Year of assessment 2016. Why are we using July to June? This hire purchase started in September. So that means from July, the beginning of the service period, which is the basis period, down to June. Okay. So the second year, let's say second year, let me use second year like this. Second year would be July 1, 2015 to June 30, 2016. That will be year of assessment 2017. Then as we are looking at it, look at the end date, which is October. October 2016 is not covered here. So we still need another year. We need another year. Third year will be July 1, 2016 down to June 30, 2017. This is where we will find our October 2016. So this is going to be year of assessment 2018. All these are your preliminary calculations. So you are asked to look for the capital allowances for these 3 years. So that being that, you will now do workings. All these are preliminary work. So you will now say workings. Number one, to look for higher charge per month. We look for the higher charge per month. Why are we looking for higher charge per month? This is because this 200,000 that you are paying. It contains both capital, capital payments, and interest, interest payments, or we can say the higher charge. So there is a need for us to remove that interest element inside of this because we don't charge capital allowance on interest. We need to know only the capital payment that is involved here. So I'm telling you the 3 steps method you use to get that. So the first one is to know the higher charge per month. How do you know the higher charge per month? Bring all the payments that you have received. Okay, let me do the workings in the next page so that let me do the workings here. So I will say workings. So the first one is higher charge per month. So bring all the monies that you are expecting. So it means that on September 1, 2014, initial deposit, initial deposit is a capital payment. Is a capital payment. How much is the initial deposit? 2 million naira. That's a capital payment. Now from November 30, 2014 down to October 31, 2016, you are paying interest or installments. Sorry, installments. So I'll say installments, which include capital and interest. So it's going to be 24 months, which we are given, multiplied by 200,000. So what would that give us? That should be 4.8 million. So let's see, 200,000, 200,000 multiplied by 24, that will give me 4.8 million. So I'll come here and I'll put my 4.8 million. So this is the total monies that you are going to pay for the whole period. So you say total cash expected to be paid should be 6,800,000, right? That's fine. 6,800,000. Now, this 6,800,000 contains capital payments in the initial deposit, capital and interest payments in the installment. Now, assuming you were to pay the cash price, so you say cash price as of September 1, 2014, we are told is 5,600,000. Now, this is capital alone. This cash price is capital alone. So, if this is the total capital you are supposed to pay, and this is all the things that you are paying, both capital and interest, you find out that when you less this from that, you have 1,200,000. 1,200,000 is total hire charge. This is purely interest. So it means that an asset you are supposed to pay 5,600,000, you end up paying 6,800,000. It means 1,200,000 is the interest. Now this is the total interest you are having here. You will now say interest per month will now be 1,200,000 divided by 24 months that you are paying the interest. So this should be like 500,000. 1,200,000 divided by 24, that will give you like 50. Let's try it again. 50 multiplied by 24, 1,200,000. So it's 50,000. So 50,000 is your interest. Oh, I'm still writing 500. 50,000 is your interest per month. That's workings number one. Workings number two is capital installments per month. Capital installments per month. All right, so amount of amount paid per installment. So you say paid amount paid per installment. Amount paid per installment, you were told here that you are paying 200,000 naira for each installment. So you come here and put each installment you make, you pay 200,000. You now less interest per installment. See workings one. So is this 50,000 that we've calculated is the interest per installment? It's what you are going to remove. That means for every 200,000 you pay, 150 is capital payment per installment. So it means that for every 200,000 you pay, 50 is interest and 150 is capital. So what happens now? The next thing is year of assessment 2015. Year of assessment 2015. Your basis period will be July 1, 2014. Sorry, it should be 2016. July 1, 2014 to June 30, 2015. Let me verify to see if I wrote it correctly here. 2016 year of assessment. Very good. So let me clear it well so that you see it here. 2016. So this is the year of assessment. So I'll put my Naira sign here. Then I will say costs of assets. What is the cost of the assets? If you look at the assets here, is generators. This is plant and machinery. And we are told to ignore investment allowance. But what I want to do here, I would like to go and bring the capital allowance. The capital allowance here should be 50% and 25. I should have put it in my preliminary workings here. Let me just put it down here. Asset type, generators, quantity. Later, the quantity will be of value. We'll know why they tell us it is 10. Quantity, quantity is 10. Initial allowance rate, 50%. Annual allowance is 25%. And when we say 25%, it's as good as saying how many years. Normally, if you want to convert this to years, you will say 100% all over 25%. So percent will cancel each other. 25 cancel year one, 25 cancel year will be 4. So that is 4 years. That's 4 years. We are told that investment allowance ignore. All right, so we started in September
Okay, so assuming that you can see my screen, sorry for the break in transmission. It was due to people calling me on my phone while the class was on. So this is monthly. So this is monthly capital payments. Monthly capital payments. So what it means here is that this monthly capital payment is from what month to what month? From September 1. Okay, so it's not from September 1 again. Your monthly payment began from when? November 2014. So your payment began from November 2014. So you will say November 30, 2014 to June 30, 2015. How many months is that? So we have November and December is 2 months. January to June is 6 months. Add those 2 months, it's going to be 8 months. So you simply say 8 months multiplied by how much is the capital payments each time we make investment in installments? 150. So you're going to multiply this by 150,000. So this 2 million is a capital investment or capital payment. 150 is also capital payments. So you simply go and do it this way. 8 months multiplied by 150, that will give me 1.2. Okay, so it means this is 1.2 here, 1,200,000. So 1,200,000 here, total costs, excuse me, total cost is going to give me 3,200,000. And that's the total cost. Then shouldn't have underlined it double. Then you will say initial allowance. Initial allowance, which is 50%, that would be 1,600,000. Then the annual allowance, then the remainder will be 1,600,000. Then this is annual allowance, which is as good as saying 4 years or 25%. You can come here and say 25% of 1,600,000, which will give me what? It's as good as saying 1,600,000 divided by 4. That's how it is. 1,600,000 divided by 4. That's 400,000, right? That's 400,000. And now this 400,000, let me write it down here. 400,000 is your annual allowance. But because it is for 8 months, you will now prorate it again. Say 8 over 12 times 400,000, because it is not up to 1 year. 400,000 times 8 divided by 12, that will give me, let me do it like this, 8 times 400,000 divided by 12, still the same thing, 266,667. But I would say this is 266,667. So this is your annual allowance. So I'll come here, my tax written down value. I will come here, my tax written down value will be what? 1,600,000 minus 266,667. That will give me 1,333,333. 1,333,333. So that's your tax written down value for the first year. So you go here now, year of assessment 2017. So that should be July 1, 2015 to June 30, 2016. I think the first one we did was 2016, so this is 2017. Okay, so you will start with tax written down value. The tax written down value is 1,333,333. Okay, then the next thing to do is, what is your acquisition, or yes, additions, or we said additions. Now these your additions are the capital payments you paid from July 30th. Of course, we said this payment span over 3 years. Span over, so this second year you made a 12 capital payments here. The first one you made 8, second one you made 12, and of course the last one you would have made 2, or you would have made 4. So July, August, September, October. So the last one you would have made 4. So this second one here you made 12, 12 capital payments. So additions would be 12 months times, okay, let me make it, okay, the dates are also here, so we know this is the period. 12 multiplied by 150, not 1 million, 150,000. Let me remove the comma so that somebody will not think it's thousand. So 12 multiplied by 150,000. So that will give me what? Let me do it here. 12 multiplied by 150,000. That will give me 1.8. So we have 1,800,000. Now that's the addition. So what you will do now, initial allowance for this addition, initial allowance. Initial allowance will be 50% of 1,800,000 That will give me 900. Okay, then your annual allowance will be done in two ways. Annual allowance, and I'll say current year 2017. It will be initial allowance minus, sorry, it will be your cost minus initial allowance divided by how many years is remaining. Remember, in 2016, we had 4 years remaining. Now in 2017, it's still that same vehicle. You didn't buy new ones. It's just that you made new additional capital payments. But you are still using that asset. So the asset has reduced 1 year lifespan. So now it's going to be 3 years remaining. 3 years remaining. And because these are 12 full months, use it 12 all over 12. You use it for 12 full months. So what it means here is you have your 1,800,000, which is the initial allowance, times the cost, you minus your initial allowance. The remainder, which is 900,000, is your annual allowance. You divide it by the number of useful life remaining, 3 years. So it's 300,000. So because you use it 12 over 12, you don't do anything. So your annual allowance is 300,000. You use it for full 12 months. That's one. Then you put the one for 2016. 2016 annual allowance. Now, we calculated annual allowance here to be 400, but because we are prorating for this first year, that is why it was 2666. So now we are entering the next year. We can't be carrying 2666. We take this full annual allowance, which is for full 1 year, because these assets now, this part has now lived for another one full year. So you come here, 400. Okay, so 400. So what happens now is you will get your tax written down value. The tax written down value will now be 1,000,008, sorry, 1,333,333. That's the tax written down value at the beginning, plus 1,800,000, now minus 900, minus 300, minus 400. The tax written down value will be 1,533,333. So 1,533,333. So that's your tax written down value. Then you will go to the next year, which is 2018. That's the last year of assessment, 2018. Before basis period, July 1, 2016 to June 30, 2017. And that's your basis period. You will start with tax written down values. Tax written down values is 1,533,333. That's the tax written down value for the year. Then you say addition, additions. So I would say from June, okay, this is not June, it's July. From July 30, 2016 to October 31, 2016. Because we said it's ending, the 24 months ended in October 31, 2016. So you see why these preliminary calculations were important so that you don't miss them. So that's how many months? July, August, September, October, 4 months. So you say 4 multiplied by 150,000. So that should be 600 if I'm not mistaken. 4 multiplied by 150,000, that should be 600. So you will say this is 600. So your tax written down value here will now be, add it to, add the 600 here, that will give me 21333, 2133333. You can come here, initial allowance, that will give me 50% of 600. That should give me 300. That's your initial allowance. Annual allowance. Annual allowance. Okay. So, of course, annual allowance for my cleaning. Annual allowance. So you start for 20, which year is this? 2018. For 2018 year of assessment, it will be 600, which is the cost, minus the initial allowance, divided by the useful years. When we are doing this one, we said 3 years useful life remaining. Now this will be 2 years useful life remaining. 2 years useful life remaining. Okay, 2 years. All right. Then, how many months did we use it for? The asset was, okay. The asset, though it was purchased, higher purchases was done, higher purchases were done on it for 4 months, which gave us 600,000, but the asset was still in use as at the end of the month. So it's still going to be 12 over 12. We were not told that the asset was sold on October 2016. Let's look at the question again. We were not told that the asset was sold after the payments were complete. So it means that for 12 months, there's an annual allowance. So what happened here is this will become 600 minus 300, which is going to give me 300 divided by 2, which is going to give me 150. So this is going to be 150,000. That's the annual allowance here. Annual allowance. Then you will come and say for 2017 You already know how much we got there. 2017 we got 300. Then for 2016 we got 400. So each time they give you higher purchase capital allowance, that's the system you are going to use. That's the system you are going to use. So when we say this one here, minus 300 is the initial allowance, minus 150, minus 300, minus 400. That will give me 983. So this is 98333. So this is your tax written down value. Now, even though that is the period you finish paying, you will still come and do another one more year, 2019, year of assessment 2019. That will be from my writing, year of assessment 2019. The basis period will be July 1, 2017 to June 30, 2018. So to be tax written down value 98333. Okay, then there is no additions. There is no addition. So what happened? What happened? There is no addition. So now this is the last year of the assets. There is no addition. This is the last year. So you simply claim annual allowance. Now say for 2019, let's leave that for now. For 2018, for 2017, and for 2016. Let me bring them one by one. 2016 here is 400. 2017 is 300. 2018 happens to be 150. What will 2019 be? Now watch what will happen now. Let's watch what will happen. Let's add all of this. 400 plus 300 plus 150. That will give me 850. Right? Let's find the difference between 983,333. The difference is 133,333. This 133,333, that's the difference. It's because of proration. That's the difference. That's what we are going to take for. So what we'll do here, we'll say this is going to be 133,333. Yes, that's going to be the difference. But because this is the last year, you must keep 10 naira per asset. You must keep 10 naira. So you minus 10 naira times 10 assets. which is 100 naira. So what it means here now, this one will give me 133,333 minus 100. That will give me 133,233. That is what this one will give me. This one will be 150. This one will be 300. This one will be 400. Okay? And your tax written down value will be 100. So your tax written down value is 100. That's for this. So with that, you will now do a summary. You will now do a summary. You will now say year of assessment, initial allowance, annual allowance, total capital allowance. This is what they are asking you to do. So year of assessment, you will now bring your answers down from 2016. So this is 2016. 2016. Your initial allowance happened to be 1.6 million. Annual allowance 2,666,667. So 1,600,266,667. Is that what we got there? Yes. So simply add them together. Simply add them together. 1,600,000 plus 266,667. You have 1,866,667. So 1,866,667. So that's for 2016. For 2017, what is your initial allowance? Initial allowance is 900. Annual allowance is 300 plus 400. 900. Then you will say 300, 400. So that's 700. So 300 plus 400 plus 900. And that gives me 1,600,000. So that's 1,600,000. Then you will come here, 2018. What's your initial allowance in 2018? You have it as 600. Then we have 150, 300, 400. So we say this is 600. And this is 150, 300, 400. So when we add them together, so this is 600 plus 150 plus 300 plus 400. And that gives me 1.4. 1.4. It is your capital allowance here, 1.4. Then for 2019, 2019, which is the last one we just did here, there's no initial allowance. So I'll put a dash here. Annual allowance happened to be, this is 133,233. 133,233, 150, 300, 400. So let's add them together to see what we get. 133,233 plus 150 plus 300 plus 400. That gives me 983,233. 983,233. So these are all your capital allowance. Now, can we do something now? Let's test something. Let's add all the capital allowances. So this is what we have in our calculator. Let's add it to 1,400,000. Let's add 1,600,000. And let's add 1,866,667. And that gives me 5,849,900. There must be a little mistake we did somewhere. It should have been 5,000,000,4 should have been 5,549,900 because of the 100 naira that we left out to make it 5,600,000. But that's not a problem. We'll look for the error inside. That should be from the first year. I think it should be from the first year. So, but you get an idea of what we have here. That all your capital allowances, if you add them up, it should give you your cost price. It should give you your cost price. Less that 10 naira that you left in your books. So that's the general thing that we are saying. So that's how to do capital allowance for uh, assets that you get on hire purchase. You can go ahead and look at how it is being done here in ICANN Park, ICANN question. You might see a little difference in style, but the general thing that the general knowledge that we are having you have here. The way I can do it is 1, 2, 3 here. You can decide to do it that way. So they have their cost here as 3,200,000. We had our cost here 3,200,000. Initial allowance was 16. Yes. Annual allowance was 400. It was not prorated. I disagree with this based on what we read. It was not used for the full year. It should have been prorated. Then these other ones here, the cost is 1,800,000. Yes. Initial allowance 900. Annual allowance 300. Yes. Plus the 400 of the other one. Yes. Then the other one is 800. That's the cost. The cost here is 600. 300 as initial allowance, 150 annual, 300, 400. That's fine. And now we have the last one. There is no cost. Initial allowance, no initial allowance, annual allowance 149 as against this 150. So it's fine. So anyway you want you understand best, follow that. But both of these methods are giving you the general idea of how you are going to do your capital allowances. Okay, so you can look at question number 2 at your own time and see how it was being done. In our next class, we are going to do more about capital allowance because that's the foundation of your knowledge, more about capital allowances. In your professional exams, as a professional level, you may not be doing rigorous capital allowance workings. You may not do it. You may do a little of them. But the essence of this class is for you to know how to calculate it each time we are given. So you need to know how to do the rigorous method, the rigorous capital allowance, so that in the exam, if they give you the smaller one, you know how it is being done. Because this rigorous exercise is contained in your study pack, that is why we are treating it. Normally, the rigorous workings like this is normally done in the skills level where they test your skills. But some people uh, get exempted from taxation sometimes. It comes straight to professional level and they want you to really know how to do this capital allowance. So we are going to be spending some time on it. Our next class and perhaps the next class after that, we'll still be doing capital allowances so that we will have our hands strong in capital allowance. So today has been dedicated to solving capital allowances with higher purchase. In our next class, we'll see how we solve capital allowances on a normal basis where we now do a restriction or where there is no restriction. As in the case of this manufacturing company, we'll look at it. Then we'll also look at, okay, this one has disposal. So you will see balancing charge or balancing allowances inclusive. We also look at capital allowances that is done when it is at the cessation of business, where we will now carry backward. So we need to know all these facets of capital allowances and see how we can play with them so that our hands will become strong. If you have any question with regards to this lecture or previous lectures that we have, or ones we've not even had, feel free to ask me via email or from my WhatsApp group, from my WhatsApp, and I'll be glad to answer every of your questions. So thank you so much for coming to class, for making it an enjoyable one with your presence. I'll see you in the next class.